When it comes to defining individual retirement accounts, the individual retirement account, IRA, was first authorized under the law by the Employee Retirement Income Securities Act of 1974. So a few important things to remember about IRAs is that IRAs are not sponsored by an employer. So any employed individual may open an IRA. IRAs are not sponsored by an employer. Any employed individual may open an IRA. Another thing is IRAs are not qualified retirement plans under the law. So IRAs are not qualified retirement plans. So what qualified plans must be sponsored by an employer. Though they are not qualified plans, IRAs have many of the same rules as qualified plans. When it comes to contributions into an IRA, it must come from earned income. You can only contribute to an IRA with earned income. Earned income comes from a job, so you want to think earned income is salary, wages, tips, and other income that comes from actually working is earned income. So even though IRAs are not sponsored by an employer, the account owner must have a job and must have earned income in order to contribute to an IRA. Contributions may be tax deductible depending on factors that'll be covered later. Contributions made for a tax year may happen in that same year or as late as April 15th the following year. So it's important to remember April 15th the following year for contributions made for a tax year. It can happen in that same year or as late as April 15th following year. Any earned income may be put into an IRA even if it isn't tax deductible. When it comes to earnings inside an IRA, earnings inside an IRA are tax deferred, meaning there are no taxes on the growth until it is withdrawn. You want to remember contributions to an individual's IRA accounts may not exceed the annual maximum contribution. The maximum increases regularly, so it's not really tested, but you can only contribute up to the IRS limit. You want to remember overfunding in IRA is a 6% penalty. If you overfund, that would be 6% penalty. A person who is age 50 or older may make a higher contribution called a catch-up. The current catch-up amount is an additional $1,000. So people that are 50 or older can contribute an extra $1,000 to their retirement plan as a catch-up contribution. Married couples may contribute based on their combined income. So if one spouse has little or no earned income, contributions may still be made into an IRA for that spouse based on the couple's joint income. And amounts contributed above the maximum, like I said, you want to remember, is 6% penalty for over contributions and 10% penalty for early withdrawals. You want to remember that certain investment practices are not allowed in IRAs or any other retirement plan. So short sales of stock are not allowed in IRAs. Speculative option strategies are not allowed in IRAs. Tax-exempt municipal securities are not allowed in IRAs. And margin account trading are not allowed in IRAs or any other retirement plan. When it comes to transfers, a customer may transfer IRA assets from one IRA account to another IRA account. You want to take note that the transfer will be between matching types. So traditional to traditional or Roth to Roth. Transfers are between matching types. This is sometimes called a custodian to custodian transfer. And you remember there is no limit on the number of times a customer may do a transfer. So if a customer moves money from an employer plan, let's say like a 401k, to an IRA, this is sometimes called a direct rollover. And you want to be careful with moving money from an employer plan to an IRA is a transfer and not a rollover. Even though it's called a direct rollover, it's considered a transfer when you move money from an employer plan to an IRA. Now, as far as rollovers, a rollover is when a customer withdraws and takes possession of IRA assets and then returns the asset back to an IRA or other qualified accounts within 60 calendar days. You want to take note that 60 calendar days is not 2 months. It's close, but it's not the same thing. So you want to specifically go with 60 calendar days when it comes to rollovers, not just going with 2 months, if you see that as an answer. If the customer successfully completes the rollover, there are no tax implications for the withdrawal, and a person is allowed to perform one rollover per person per 12 months. So you want to think rollovers are allowed once per person every 12 months. Contributions to all IRAs for a tax year may not exceed the maximum set by the IRS. The number is adjusted as often as annually, and the specific amount is not tested. When it comes to withdrawals, distributions may begin without penalty after age 59 and a half and are generally added to ordinary income for tax purposes. So withdrawals from IRAs is considered ordinary income for tax purposes. Distributions before age 59 and a half are subject to the 10% penalty, as well as regular income tax. But there are exceptions to the 10% penalty. A few exceptions that avoid the 10% penalty for early withdrawal would be death of the owner, disability of the owner, a first-time home buyer's purchase of a principal residence up to $10,000, education expenses for the taxpayer, spouse, child, or grandchild, medical premiums for unemployed individuals, and medical expenses in excess of defined limits would be a few exceptions to avoid the 10% penalty for early withdrawal. And when it comes to required minimum distributions, RMDs, you always want to connect RMDs to traditional IRAs because Roth IRAs do not require a minimum distribution. RMD stands for required minimum distributions, and they are distributions from some retirement accounts that are required beginning in the year the account owner turns 73 and annually by December 31st after that. So RMDs get triggered when the account owner turns 73 with traditional IRAs. As far as the amount of the RMD, it's based on the account value as of the end of the previous year. So if an investor has more than one account, the total of all the accounts is used to determine their required minimum distribution. The account holder may choose which account to take the distribution from. The first required minimum distribution may be delayed until April 1st of the year after the account holder turns 73. And if the RMD is delayed in this way, there will need to be a second distribution by December 31st of that same year. If an account holder fails to take the required minimum distribution by the required date, the difference between any amount that was withdrawn and the required minimum distribution will be subject to a 25% penalty. So you want to remember, if somebody with a traditional IRA doesn't start withdrawing by 73, the amount that they should be, they will get penalized 25% on the amount that should have been withdrawn. So you can remember 25% penalty with required minimum distribution. And required minimum distributions, RMDs, are attached to traditional IRAs, not Roths. Now with employer-sponsored plans, so remember IRAs are not employer-sponsored. So now we're going into what is employer-sponsored. Well over half of all employees in the United States have a retirement plan through their employer. For many, when they contribute to the employer plan, that is their first time saving for retirement. So these types of employer-sponsored retirement plans fall under the Employee Retirement Income Securities Act, otherwise known as ERISA, ERISA. And ERISA is a law that sets standards to protect retirement funds from employer mismanagement. When it comes to a defined benefit plan, there's a few rules with defined benefit plans. Defined benefit plans are also called traditional pension plans, which defines the benefits it will pay to retirees. The plan will determine a benefit that retirees receive based on years of service, age, and salary at the time of retirement. So they're gonna base everything once the retiree has officially reached retirement. Will they determine the benefits? The plan will be a replacement of a portion of the pre-retirement income. When it comes to employers will use the services of an outside firm to determine how much the company needs to contribute to the plan to have sufficient assets to meet the defined benefit payments. Employers are required to make the payments as defined in the plan. This places the investment risk on the company, and many companies are moving away from these types of plans. So you want to remember, defined benefit plans are a risk to the company. And these are plans that basically require the company to make sure they pay you an exact benefit of, the time and energy you put in. And companies, don't like that they have to guarantee and define a benefit that they owe you. You can think. So it's risky to the company, and they're trying to get rid of or avoid using these types of plans. With defined benefit pension plans from private employers, they pay a fixed benefits. Once the employee begins to collect benefits, the amount will not change. Pensions from government agencies often include a cost of living adjustment. As far as defined contribution plans, as the name indicates, defined contribution plans define the amount that may be contributed to the plan. Employees in these plans will have a balance that they may invest within the plan. So at retirement or when changing employers, employees may take possession of the assets in their account, often transferring the assets to an IRA for distribution during retirement. Employers may be required to contribute to the plan depending on the type and specifics of a particular plan. A short list of defined contribution plans. You remember, defined contribution plans are 401ks, 403bs, profit sharing plans, money purchase plans, and simple plans, such as simplified employee pension plans, SEP IRAs. Those are types of defined contribution plans: 401ks, 403bs, profit sharing, money purchase plans, and simple plans. And now these defined contribution plans are more popular than defined benefit plans because the investing risk of a defined contribution plan is carried by the employee. So you want to remember, defined benefit plans is a risk to the employer, whereas defined contribution plans or a risk to the employee. So with contribution plans, the liability for the employer is much smaller.